Hey guys, Tom here from the Investing with Tom YouTube channel. One of the things that I always say when investing in the stock market is to buy stocks that are trading for less than they're currently worth. And one of the obvious questions that comes out of that is how do you actually figure out what a stock is worth? How do you put a value on Apple stock? How do you put a value on Facebook stock? And that's exactly what we're going to dive into today. So we're going to have a look at one of the methods that I use to value businesses. If those businesses are trading at a significant discount to that value, then I go ahead and purchase them, assuming that I really like the business and I think it has good prospects. So let's dive into that. Let's head over to the computer. If you enjoyed today's video and the value that it provides, be sure to hit like and also hit subscribe for future videos. But without further ado, let's get into it. How to value stocks. Alright guys, so we're over on the computer now, and for today's example of a valuation, I'm going to use Apple. So I'm sure you're all familiar with Apple stock. It's currently the largest investment held by Warren Buffett at Berkshire Hathaway in terms of his public holdings. So I thought it'd be a really good example and a company that you'll all be familiar with. So this is going to be an example of how I would actually put a dollar value per share on Apple. And this is a method that I've basically pulled from Phil Town. So you may have seen Phil Town's books. You may have come across Phil Town on YouTube. If you haven't, definitely look him up. But essentially, this is the method that he lays out in his first book, Rule 1, and also across his other books, Payback Time and Invested, the book he wrote with his daughter Danielle. So there's a few bits of information we're going to need. So the first one I'm going to grab is earnings per share trailing 12 months, or EPS TTM. So over the previous 4 quarters, how much has Apple actually earned per share? So a place I'm going to use to grab a lot of this information today is actually just Yahoo Finance. So I've got Apple open here on Yahoo Finance, and we'll find quite easily EPS TTM of $11.89. So that's the first figure I'm going to grab, 11.89. The second figure we're going to need is a growth rate. So the way that this valuation is going to work is it's going to forecast the future earnings and the future value of Apple. We're going to assign a certain return that we want to make from this investment, and then sort of work backwards to what we can actually afford to pay for Apple stock today. So part of forecasting and looking forward is making an assumption on what we think Apple's growth rate of earnings is going to look like over the next 10 years. So for this reason, we tend to use this valuation with quite stable companies. This isn't something what you tend to use with a really cyclical business or a extremely fast growing business, just because there's so much room for error. There's obviously still room for error here, but we're going to apply a margin of safety shortly, as you'll see. So in terms of the growth rate, you've basically got 2 options. So you can make your own judgment call on what you think the growth rate is going to be, and that'll obviously come from your research on Apple stock. For today, I'm just going to use what the analyst consensus is for growth rate. So back over to Yahoo Finance for Apple. I'm going to head to analysis, and if I scroll down, we're going to see a forecast growth rate for the next 5 years, just here, of 12% per year. So that's the growth rate I'm going to use today, 12%. Minimum rate of return. So this is the actual rate of return that we want to make on our investment, and I'm going to plug in 15% here. And this is something that, this is the same number that Phil Town uses as well. It's a rate of return that's much higher than something like an index fund or the S&P 500. So when we invest in individual companies, we're obviously looking to make a higher return than the S&P 500. If I wanted to just make a 7 or 8 or 9% return, I could invest in an index fund and just kind of do that. But when I'm going and picking out individual companies and taking on the risk associated with picking individual companies, I want to get a slightly higher return out of it. So I've gone for 15%. Margin of safety, we're going to go with 50%. So once I actually figure out what I think Apple is worth, we're only going to buy Apple if it gets to 50% of what I think it's worth. That offers a big, big margin of safety, a lot of protection. If I can buy $1 for 50 cents, that gives me very limited downside, and it also gives me a lot of upside. So the main sort of consensus out there in the investment world and in plenty of other areas of life as well is that if you want to make a higher return, you have to take a lot of risk. in value investing, we take exactly the opposite approach. So the bigger the margin of safety you can get, the less risk there actually is, and the greater return there is. So we're always hunting for that big discount to the true value and a big margin of safety. So that's 50%. The PE ratio, so that's the price to earnings ratio. I've done a video on this in the past if you want to go and look at that. But essentially the PE ratio is how much we think we can sell Apple for in the future in terms of a multiple of their earnings. So if I think we can sell Apple in 10 years time for 10 times earnings, we'd put a PE of 10. And I find that there's sort of two approaches we can take here as well. So the first approach that Phil Town recommends is just using 2 times the growth rate. So that would be in this case a 24 PE. Obviously, a lot of companies won't trade at that higher PE, or they may even trade at a lower PE than 2 times the growth rate. But that's a good starting point if you're not too sure which PE ratio to use. For Apple, I know that they actually trade slightly lower than 2 times the growth rate. So I'm going to head over to MSN Money, and this is going to actually be a really good place to pull up some historic PE ratios for Apple. So I'm going to look up Apple on MSN Money, come over to financials, and there's a section here, analysis. And there's a section here called price ratios. So if we go to price ratios, you're going to see a 5-year high PE, 18.49, and a 5-year low PE of 12.45. So I'm simply going to take the average of those and work with that one. So if I head back over to here, I'm going to go equals 18.49 plus, what was the other figure? 12.45. Divide those by 2 to get the average. And I recommend using whatever comes out as the lowest of those 2 PE options. So if the average 5-year PE came out at say 40, but our double the growth rate PE is 24, I'd go with the lower one, which is 24. In this case, the lower one is the average PE, so we're going to go with that. So the next thing we've got to do is forecast what the earning power of Apple is going to be per share in the future. And I'm going to use some of these figures to do it. So we're going to start out in year 1, we're going to have year 2, year 3, year 4, year 5, and we're going to go right out to 10 years out into the future. And we're going to start with current earnings of $11.89. And what we need to do is we're going to grow these earnings out for the next 10 years. So this one is so in year 2, we're going to have $11.89, but we're also going to have 12% increase in earnings. And I'm just going to lock that value in as well. So the next year, if earnings grow at 12%, we're going to have $13.31 in earnings. And I can pull this straight across for the rest of the 10 years. So in 10 years' time, if Apple continues to grow at 12% per year, as the analysts expect, then we now have earnings in year 10 of $32.97. So once we've got those future earnings at $32.97, we're going to multiply by our PE ratio. So if Apple's earning just under $33 in 10 years and we can sell it in 10 years for a PE of about 15.5, then we can work out the value. So we're just going to multiply that 10-year earnings by the PE. That gives us a estimated share price in 10 years' time of $510 per share for Apple. So well done, we've worked out the future value. We now need to figure out what we can actually afford to pay for it today. So if I want to make a 15% minimum return, which is what I've got in there, I basically need to work backwards, decreasing that $510 by 15% every single year to model what that share price growth might look like over time. So to do that, I'm going to divide that one by 1 plus 15%. And again, I'm going to lock that value in. Cool. So if we work back 1 year, 15%, we go down to 443, and I can work all the way back to year 1, and we get a fair value today for Apple of $145. So that is a very quick valuation of Apple. $145 per share looks like a fair value based on the current earnings and the current growth rate of Apple. $145. But stick around for the last couple of minutes of this video. So as value investors, we never buy shares of companies at a fair price. We want to apply a margin of safety. Up here, I've got a 50% margin of safety, quite a big one. So I'm going to apply that. And that's telling me that a buy price with a big margin of safety, a big fat margin of safety, where you can expect to earn much higher than 15% returns, is $72.50. If it ever got to that price, I would be loading up at $72.50. I may move into Apple at a slightly higher price than that just because it is so stable, and I am very confident that Apple's going to grow and continue to do well over time. But that's a quick valuation on Apple. I really hope you've enjoyed the video. If you did, be sure to hit like and subscribe for future videos. But that's all from me today, and I hope you have a great day wherever you are out there. Cheers.